Converting liabilities to revenue. This segment's learning objective is to prepare adjusting entries to convert liabilities to revenue. Customers sometimes pay in advance for services to be rendered in later accounting periods. For accounting purposes, the cash received does not represent revenue until it has been earned. Thus, the recognition of revenue must be deferred until it is earned. Advance collections from customers are recorded by debiting cash and by crediting a liability account for unearned revenue. This liability is sometimes called customer deposits, advance sales, or deferred revenue. As unearned revenue becomes earned, an adjusting entry is made at the end of each period to transfer an appropriate amount from the liability account to a revenue account. This adjustment reflects the fact that all or part of the company's obligation to its customers has been fulfilled and that revenue has been realized. Now let's look at the adjusting entry associated with converting a recorded liability to a revenue. The adjusting entry is necessary when cash has been collected in advance of earning revenue. An example is when a magazine publishing company collects cash for a 1 or 2 year subscription. Other examples of transactions that require an adjusting entry to convert a liability to revenue are the sales of airline tickets or season tickets for a sports team. At the end of the accounting period, an adjusting entry will need to be recorded to recognize the revenue earned during the period and to reduce the liability account. On December 1st, Harbor Cab Co. agreed to rent space in Overnight's building to provide indoor storage for some of its cabs. The agreed-upon rent is $3,000 per month, and Harbor Cab paid for the first 3 months in advance. Because Overnight prepares monthly financial statements, it should recognize $1,000 per month in rental revenue on December 31st. Let's see how this transaction was recorded by Overnight. On December 1st, Overnight debited cash for $3,000 and credited the liability account called Unearned Rent Revenue for the same amount. Don't let the word revenue in the liability account title mislead you. The important descriptor is the word unearned. Unearned revenue is a liability. Overnight must do something to earn this revenue. Let's look at the journal entry required on December 31st to recognize the revenue earned during the month. Initially, revenues that benefit more than one accounting period are recorded as liabilities. On December 31st, Overnight would debit or reduce the liability account unearned rent revenue and credit or increase the rental revenue account for $1,000, 1 month's rent earned. Over time, the revenue is recognized as it is earned. The balance in the unearned rental revenue account represents 2 months of unearned rent at $1,000 per month. The balance in the rental revenue account for December is $1,000. This amount will appear in Overnight's income statement.